Okay, this is a video on. I'm gonna try this. I don't know how this is gonna work, but I'm gonna go to the models, and this time, let's go to stock prices. And the first thing I'm gonna do is let's get the stock prices for uh, the stock prices for renewable energy chips. Okay, now. I think I'm not gonna. This time, you'll be thankful that I'm not going to redo anything. But what we can do is we've got a list of the various stocks. This is all on Yahoo.finance.com, which I think if you saw some of the other videos has kind of the very good, adjusted stock price data. I assume it does. So what you do is you just press clear sheets. Okay, and then what it does, there's a little macro that just goes back and clears all the data. Now, if you look at this one, uh, hang on, there's nothing here. Now, if I pressed formulas, it should and calculate now or something. We should get a bunch of references. It should all break. Okay, there we go. Okay. Now you just press get data and it'll get the latest data here. This says get it from today, and you can look at this, but it's all working with workbooks.open. So we're going to get the data now. I'll press get data. It's going to take a while. I'm not going to sit here and leave the video on while it's doing it. It's going to each sheet and getting it. I've had these little problems. What I do down here is I have to wait just a minute. We get General Electric, Vestas, we get kind of all this. I try this with different industries. Um, with corporate valuation these days, one of the big tricks is getting data. A lot of people, you have all the Bloomberg and everything. Maybe you don't have to do this and whatever. I like to get the real data, see what it really is. Now, um, the what I'm going to do here is try to show you just how bad beta is. Is that okay? That's all I'm going to do. How bad is beta? How it just doesn't mean anything. How it changes over time. How to calculate it, and ultimately in the next video what we can do as an alternative. So perhaps I'll name this one some problems with beta. Okay, and it's just going around, and I'm going to pause it now. Let's here let's look at, I switched to the index chart, and I'm looking first at GE. Now, the way this works, you can look at other charts and just study them, but the first thing I would really want to do is study what's happened. So in this case, look at the difference between General Electric and uh, come on. Um, GE has a beta of 1.18. If we look at uh, the this is just the blue line, the market index, the S&P 500. This is the Black Monday or Tuesday or whatever it was, and this is the .com and the Lehman, and look at what's happened now. My God, uh, um, the here's the beta is supposed to measure the relative risk, of course. So this is 1.18. Now what I did is made a flexible one. So if we start in, let's start just before the dot-com crisis. Okay, well, now the beta hasn't changed dramatically, interestingly. And if we just go back to, oops, this is, and then we look at this, then it's beta's 1.09. Now you might say, okay, that's not that much of a difference. Let's just look right what happened in kind of only let's go to some like 2006 and go down to after the kind of stock price crashed. So here's the then this is the real crash. Here the blue one is the market and the red one is GE. So GE fell from 1 down to 20% of its value. The market fell from 1 down to about 50% of its value. Why don't we start in something like January of 2008? Okay, and I'm trying to show you that if you just, well, it's still only 1.23, but if I would just say the percent decline in the market versus the decline, this went 20% down by more. That's the kind of key thing, and now that's what you can do with these graphs. Let's look at Vestas just for a minute. And now when you press Vestas, it goes back and gets the whole series. And of course, here, look at this. It goes up and down, came down by a lot more than the stock. This looks like it came down by twice as much when the stock market crashed, but the beta is only 1.08. Now, to compute the beta, let's just compute the beta. I'm just trying to knock the beta, really. How can you tell me that Vestas is that much less risky than GE? And now let's try some else, Gamesa. Okay, the same industry. I guess we have a 1.08 beta, so the industry must have but again, you have an immense crash and everything else, and so supposedly because the market just was going up and down, and these weren't corresponding to the market, we don't have these. This another one. Who's this? Nordex. This has 1.36. Synoval. Well, this is kind of unfair because that's not against really the U.S. market. Suzlon 1.1. They all seem to have a low beta, suggesting a low cost of capital. Let's look at the solar industry. Suddenly 1.71. But if you would do the same thing, let's take the first solar and just go to 2009. Then we have, oh, it's not that different. Shit, I thought it would be. Let's go to here. Then 1.47. The beta is clearly not stable. Is that okay? The beta is not stable. It doesn't make any goddamn sense. Did I prove it or not? I don't know. Let's look at another one. This is bankrupt one almost. This doesn't really work. There's not enough. Here's SunPower. Beta 2.19. Why is this beta twice as much as the others? Maybe because this is an enormous decline when the stock market declined. So that's what the beta's measured. Whether that has anything to do with the future or not is, of course, the problem. Now, if we want to compute the beta by hand, we go to the Oh, look, we didn't have this one for this company. Where is First Solar? So we go to First Solar. If we want to do this, the first thing we do is get the. Let's put FSLR, and let's just put an equal sign now. If it starts to go too slow, I might have to turn the thing off. And then we put the index, and we can try any index we want, and we should spell it with an X. Oh, come on. Okay, and then what we do, one way is, I think the easiest way is look, L-O, and then we go to the date, and then you go to the index, which is over here, GSPC, click on the entire thing, and then click on the entire adjusted close price. And just that fast, you can array it. So using the index is crucial, and then put percent change. And then let's do the percent change FSLR, and percent change in index. Now we need to go to this one, divided by the last. Well, let's do the fancy. You're supposed to do log of this one divided by this one, and then this just goes across, and you can graph it and do all kinds of distributions. If you wanted to make we say the beta, the equation is the percent change in stock equals A plus beta times percent change in the God, I'm having a bad day, in the index. So we just put, to get the beta, if we want to take it, now you can do it for different lengths of time. I'm going to do it for the entire length. So the beta is just the slope. So you can just put slope, and you put known y's, and then you known x's. So that's our 1.75, and we put beta first part of the series equals slope, and let's just how about we'll go down to about I don't know how well, to 2000. Let's go to 2010. How's that? So we go just to 165, and then you can press this one, shift control up, and that stayed pretty flat actually. Let's do the same thing, equal beta equal slope, and we go down to, okay, oops, okay, how about we'll stop there, and we do that one, and then it's a pretty big difference, 2.06. So that's how to compute beta. Okay, now the next thing that's so horrible about the capital asset pricing model is that you have to come up with this expected market risk premium, which is just it's just a psychological variable. There's no other way to say it. If you did any economics around it, and people have written more on this one than anything else, it's just unbelievable. But if this stock market, if this kept going up, why can't I get rid of these things? If this keeps going up like this, there will be nothing, and the economy grows by 2 or 3%, there will be nothing left for anybody except stockholders. This goes up because of profits. If profits keep going up, causing this to go up, there will be nothing left for anybody except shareholders in companies. This issue of suggesting that the market risk premium can be a high number implies that more and more, if that's higher than if that's very high at all, let me just put it that way, the profits have to grow to support that number, and the rest of the economy has to go down by less if that's a whole lot higher than the rate of the growth rate in the economy. So those are some of the problems with the capital asset pricing model. I think well, let's look at the next problem with beta. Let's go and let's look at some. How about we'll go to finance.yahoo.com. Okay, and then whoops, why did it go here? I wanted to go to, okay, I thought I pressed that. What, is it going to my website when you press that? That would be nice. Let's put FSLR. FSLR. Okay. Okay, and that one, we have the stock price went way up. They had an earnings announcement. It's at 52. And what's the beta? Well, to get the beta, I guess you have to go to the key statistics. And there's the beta, 3.23. So we just computed the beta for this company. We got something completely different. Which one should we use? Notice how the price to book is just about 1. Remember that. And notice how the return on equity, is pretty putrid at about 3%. But we need to recompute that, because sometimes if you trust these data, this data from these websites, it's not wrong. We'll show you that in a kind of second video. Let's make another one. How about let's go to Google Finance. Okay, and then we'll put FSLR in here. How do we do this? So this is this horrible thing where you have to go to the stock screener, I guess. And where do we do this? Just a minute. Where do I put the? Oh, come on. Fuck. Sorry, you all knew that. I had to put it up here, of course. Sorry about that. But here we have, does it give you the beta? Here, beta 2.02. That's pretty dramatically different if you apply it to the capital asset pricing model. And remember, when we did our own analysis, we kind of got different answers, but we put the First Solar in here. And we get 1.71 if we take it for the entire period. And if we take kind of the last 5 years, so that's 2015, 14, 13, 12, 11. Let's okay. Okay, then it's 1.92. It's a little bit closer to Google Finance, but way different than finance.yahoo. And finally, if you go to the disk, now I happen to do a case study on this one. So if we look at case studies and then we look at First Solar, when we look at the value line report for First Solar in 2014, let's look at that one. Then we get a beta of 1.3. What are you supposed to do with all these different betas? Enough said. enough said, and I haven't even gone into the crime of how using a 6 or 7% market risk premium, how all that works. That means that, people, I guess just the income gap will just get bigger and bigger and bigger. Maybe that's fine. So let's not save this. Yeah, let's save this. I'm going to save this. And I'm going to stop this video.